for what's today, Wednesday. We're into September 5th. We're rolling along here, clearing the way to the upside. Here's what we call, even if you didn't catch the upside, to strip out the randomness, transitional moments, we call them B to B. When can you see a chart that shows you a pattern of a transition to say one side is in trouble and the other side might be in control? And then if you're wrong, you find you know where that is too, but stack probabilities for what we call B to B. What does B to B stand for? If you haven't been around me a while, it's either bullish to bearish or bearish to bullish. B to B. It's a transition. One side had the torch, they handed it to the other side, or the baton. And so what we're seeing here today is a tough early market that had this dip. This is what was troubling from today. You had this quick move lower to 27, and it was on a tweet, but then they realized that the tweet was a quote from Trump to Sam Zell. It wasn't Trump saying it. So bam, they run them back up. All of this doesn't happen without that tweet that came out. I get stuck here near the lows, get out, catch a little bit on the upside to get it back. But obviously, not horrible, but just got me out of my game. Anyway, at some point we knew and we said we're going to break through these lows. It just sucks trying to get short, because if you're short in a bad location, you're not going to hold on. So what do? I don't get short in an awful location, but I don't sell the upticks. And I told people, sell the upticks, and I tried and I didn't get it. What I mean is, when a market, just look at my arrows, if you think a market's going to go down, right, it doesn't just go down. It does this, right? And so it's like you want to sell an uptick in a tougher market that's begrudgingly moving north or south. You want to sell an uptick. So then there's a little bit less risk because the rubber band stretched, so it maybe does go down. And if you're wrong after let's get rid of some of these drawings. If you sell an uptick and you sell it there, if you're wrong, it's better than being wrong after you sell it when it goes down, because then the rubber band has more of a chance to go up against you than it would in here. So you just manage your risk better, especially on a day where it's a little tougher to move. And so selling into these upticks, if you thought that the bottom of all these swing lows were going to get taken out, and they did, they went down, had to dance around, then went down a little quicker to an area that we said was probably going to be a target, the 23 even area. So anyways, instead of getting short in this uptick, and I tried, I ended up getting short a little worse. And so I didn't make as much because I was in a worse location, and I didn't hold on to it for the entire slide. So again, locations are really important, especially on days where it's a little tougher and choppier. Now, when you're in here, how could you predict that we're going to go up? It's all about finding location, but if you had a better opinion, that helps also. It was right in here. We had a live transitional moment. Why is that a transitional moment? Well, you got to be able to read this, and that's why you got to be in the room real time to understand it. Right now, this market, if you just look at it right here, it's weak, right? It starts from up here, goes down. It's a lower high. These are all things you know. It's a lower high, makes lows through there, puts in a nice low there. On the pullback, it just retraces barely 50% from up here to down there, right? All of a sudden, you can't say that those are higher lows just yet. However, when you move this in real time up like that, right there, now you could say people who are short for the right reasons, probably a little pissed off. And that's what I said. Upside's going to be the right side, at least temporarily. And these lows probably are in because of this B to B, bearish to bullish. That's a pattern. Just pretend you're short. I don't care where you're short from. When you see this, you're going to be mad. When shorts get mad, they become buyers. When there's enough shorts who are mad, there's enough buyers to keep the upside the right side. Still the same concept of, hey, you're going to play this thing to the upside, you're going to have to buy down ticks. You're not selling upticks. That's to get short. You're buying down ticks. Because if you buy it near the high, you're subject to all this. You probably puke it, and you're not on the team. So you got to buy it when it curls back down, find a good location to get long. And there's ways to do that especially if you're trying to do it. One of the things that help people is the market's slow and it's a little choppy, it is moving, and you're trying to get anxious. Instead of getting in where you'd otherwise get in, think about where you would get out for a loser and get in there. You want to take this up on a microscope, which is what the footprint does, gets inside these charts. You could see that when it finally broke out through the 26.5 area, which is right in here, okay, you could see this uptick, and then this uptick was the one to catch. Not in hindsight. This was a chance that, hey, if I'm wrong, I know where I'm wrong at. Now, if you look at these reds here, you might say, well, I got to wait till it gets up to these reds. Whether you do or not is up to you. But the key is, you know, you're wrong above the reds. That's what good support resistance also tells you. Where to manage your risk, where to get out, where you're wrong. You know, I was short in a kind of not a great location. I was mad I didn't get him up here. So because I got him down in here, I got shook out because of all this chop. I didn't want to turn a winner into a loser. If I was short from up here, you could get out of some in here and then be on the team for the move to where you think it's eventually going to go, which was 23 even area. And just quickly, why 23 even area, if you're asking? We went over this when the damn market was trading, and it's simply because in the overnight session, that's where this damn thing spent some time. The last place it spent some time and maybe built out some value in people's position was all in here, this chop. Take the middle of this chop over. Where does it take you? Takes you to 23, so it goes to 23, chops around, and then moves north. So it's just a decent place to target, not necessarily to get long, but to get out of a short if you put yourself on the right side with the good location. Now, when markets are trading good, they're moving faster, and they let you, if you got the right opinion, pick a bad location and still make money. Sell it after it breaks because there's more to it, right? There's more breakouts in volatile markets. So they allow you to buy it higher, sell it lower, and still get paid. But in slower, choppy markets, you got to be patient. You got to make sure you're location conscious. And a great exercise I mentioned in the room. Not with Sim, do it in the micros. They make it cheap. Do it in the micros. If you're learning how to trade or you're struggling to trade, what are you going to miss if you just trade in the micros to try to practice? The exercise, though, is trade it from one side that day. That's it. Play it from the short side or just from the long side and work on location. What it does is it strips out the emotion of being wrong. So there's all these exercises that people should do, and in most education, nobody provides it. Everything else you learn, there's drills, there's exercises, there's quizzes, there's tests to give yourself confidence that you're being able to do it right. But in trading, there isn't any of that. People think they're going to learn from their trading losses. And what do I say? The only thing you learn from your trading losses is how to subtract money. Your arithmetic might get a little better.